All right, hello everybody. Hope everyone's doing well. My name is Mark. I am the stock market jobber. I'm a former institutional trader. I traded directly for two of the greatest in the industry, or actually in the history of the industry. You can see that in my bio. I was also a market maker. I was head trader of numerous hedge fund strategies. So when it comes to trading, there's really not too much I haven't seen. I've been around the block a few times, and this isn't really a trade recommendation, but I think that this chart of Tesla can really teach a lot of things about trading, or about, I should say, chart reading and what charts are all about. So many people that try to understand technical analysis can't, because some of the, or in my opinion, most of the so-called experts out there really don't know what the hell they're doing. Okay, they don't understand it. When you look at a chart, what you are looking at is an example or a graphical illustration of human psychology. The markets are all about psychology. Okay, like for example, I don't know, 2 weeks ago Tesla was worth $140 a share. Now it's worth $200 a share. What has changed? You might say, well, they came up with a new model. Well, then, a few weeks ago it was worth $300 a share. The fundamental reasons cannot justify the moves. Reading charts is all about understanding investment psychology. Now, let me show you what I'm talking about. Notice how this level that was support, this is the $200 level, has become resistance. Okay? Markets are going lower. There's not enough support or demand or buy orders to take in all of the supply. So sellers are forced to sell their shares at like a discount. That forces a downtrend. When a market gets to resistance, when a market's going up, it's because there's not enough supply to fill all of the demand. And when it gets to resistance, the tide turns. Okay, there all of a sudden there is enough supply or sellers to fill all of the buy orders. And the reason why a market or a stock in this case might all of a sudden break down from a resistance level is because the sellers or the investors who are hanging out trying to sell at this price, which is 310, start to get antsy. They start to think, oh boy, there's other sellers around. That's why the stock has stopped going up. So they start to think, gee, if I want to get my sell order done, I got to be the lowest price in town. So I'm going to go down to the 309. No one's going to go pay 310 from someone else if they can buy it from me at 309. Then maybe another trader sees, oh, this guy just went to 309. I'm going to have to go to 308. And it calls the snowballing effect. So when we see resistance, we have to understand that there's human behavior and human psychology behind this. Now, notice another example of investment psychology or human behavior. People like to buy at nice round levels. The $200 level was support here and here. When Tesla was going down, there were probably a lot of people that said, okay, well, this isn't a downtrend. I'm not going to buy it yet, but if it gets to 200, I'm going to step up and buy it. Humans like nice round levels. And if you're a retail trader, you're an institutional trader, I've seen it on both ends, right? Now, what is this? Okay, we sell off and we get down to here. Why would a level that was support become resistance here? Support, resistance. This happens because of buyer's remorse. This is an illustration of psychology. People that bought at 200 thought they did a great thing when the shares went to 300, but when the stock drops below 200, assuming they still own it, a lot of these investors say, man, I made a mistake. They're remorseful. They become remorseful buyers. And when markets are going down, remorseful buying is a common thing, right? You bought, the market goes lower, you think you made a mistake. So what do? Well, a lot of these remorseful buyers tell themselves, I want to get out, but I don't want to lose any money. So I'm going to sell if it gets up to the price I bought it at. That way I can exit the position at break even. So buyer's remorse can turn a support level into resistance. And as we can see now, Tesla closed at 196 today. It's resistance again. Now, why would a resistance level remain intact? It was resistance in oh, I don't know, it's probably mid-July and this is probably September. Well, there were people who bought at the peak who regretted doing so when the shares went lower or when the price went lower. And they said, if it gets back up to where I bought, I'm going to sell so I can get out at break even. And that's why resistance forms at a former resistance level. This is a perfect example of market psychology. Back here, we see what we call lower highs. And this could have given us a clue at, well, I mean, if you're a member of my class, you would have known this. So you should really right now subscribe to Stock Market Jobber, our YouTube site. But notice how this peak is lower than this one. This peak is lower than this one. This peak is lower than this one. This is what we call lower highs. Markets go in peaks and valleys. They don't go in straight lines. And if the peaks are forming at lower levels than the previous peaks, it tells us that the sellers are getting more aggressive. And when you get aggressive sellers, it tends to push the price down. So psychology is why we have price levels that are more important than others. Now I'm going to go down here and talk about momentum. This is the relative strength index or the relative strength momentum indicator. It shows momentum, or it's a graphical illustration of momentum. If this blue line gets above the red line, well, it shows that buyers are euphoric. They're kind of getting crazy. They're paying too much. If the blue line gets below the red line, it shows that the sellers are getting crazy. They're starting to panic. They'll sell at whatever price. So back here in October of 21, this was literally, according by this measurement, the most overbought Tesla had ever been in the history of the company, which I didn't even know, but Tesla's been public since like 2011, 2012. Most overbought in history, perfect time to sell. Let's fast forward to like a month and a half ago. It was the most oversold that it had ever been in history. Again, this is psychology, okay? You can't look at a chart if you don't understand that you're looking at market psychology. And this is the reason why most technical analysts, most technical analysts don't know what they're doing. They don't understand that what we are doing is looking at a graphical illustration of supply and demand. Now, once again, I got to self-promote myself. I traded for Steve Cohen. I traded for Mary Gabelli directly. I literally talked to them. I was a market maker. I was the head of trading at 3 different institutional money managers. So at this point in my life, I've decided to kind of give back by teaching people. So these lower highs are psychology. And sellers are becoming more aggressive. Overbought shows euphoria. Oversold shows panic. Now, why is it a good time to buy during euphoria? Sell during euphoria? Well, if the vast majority of investors are euphoric, what have they done? They've bought the stock. If the vast majority of investors have bought the stock, what happens? The market runs out of buyers. And if the market runs out of buyers, the only way it can go is lower. Now, fast forward back up to here, we got the most oversold in history. Investors were panicking. If the market runs out of sellers, what happens? The only way it can go is higher. So momentum is a graphical illustration of human psychology. Support and resistance levels are a graphical illustration of human psychology. The 200 level has now become resistance because of buyer's remorse. Investors who bought at 200, they thought they made a good move when the market went higher, but when it went lower, they regret doing so. They decide to sell. Why is it at 200? Because investors like nice round levels. So that's it, everyone. If you really want to learn about technical analysis and how it really works, please make sure you subscribe to our website, stockmarketjobber.com. Well, actually, you can just check out our website, stockmarketjobber.com. But please sign up for our YouTube page. I think if you join our class, you're really going to learn. I was searching some of these YouTube trading classes the other night, and I don't even know what to say. I just think it's embarrassing, and I don't know if people are out there putting out garbage on purpose to rip people off. or if they believe it. But in the institutional world, trust me, I was there for 2 decades. No one listens. No one thinks about Elliott waves. No one thinks about Fibonacci. No one thinks about Gann theory. What we think about as traders in the institutional world, where we're trading hundreds of millions of dollars, is what are the important price levels, what is the trend, and what is the momentum. All right, that's it, everybody. I hope I didn't insult anyone, and I don't mean to. I'm here to teach. And I will see you soon. Thanks, everyone.